Hello, everyone, and welcome to OETV. Welcome to the start of your work week. The UK is closed today for the Queen Elizabeth's funeral. The media has all of its attention focused on that today. But you know where they're going to be turning on Wednesday? That's going to be focusing on the Fed with a 75 bip rate hike expected. So there's going to be plenty of media covering that. So we're going to be talking about a lot of other things for you to focus on for this week. As usual, we have Brendan McCarty back with us from Column E. How was your weekend, Brendan?
Busy as always. How about yourself?
Always busy, Brendan, but a great weekend and great to step away from those difficult markets last week. The S&P posted its worst weekly performance since mid-June on the back of recession fears and a higher than expected CPI print. FedEx pulled its full-year guidance and warned it will implement cost-cutting initiatives to contend with the soft global shipment volumes due to what it sees as significantly worsening global economy. Brendan, there really wasn't much good news to take from last week. Should we be battening down the hatches here?
Well, the cracks are definitely forming. We posted our latest new little piece called Chart Views last night, and we covered all the indexes just via the charts, those chart views. And what really stood out for us was the weekly charts all look really like weak, no pun intended. I had to write that up last night. I couldn't do weekly and week at the same sentence. It was took me a second. But anyway, of the three that we look at and we monitor, the S&P, the NASDAQ, and the small cap 6, the S&P has an outside week down, and on that chart you can see it there. We haven't had an outside week down in ages that I remember or I noticed. Maybe we've had them, I just didn't notice it. Outside week downs are major reversal patterns, a higher high and a lower low. NASDAQ and the small cap 6 didn't have exactly that, and that chart actually, it's right at the bottom of the wick. So it didn't actually, if it closed a little lower, you would have had a nice formal reversal, I think. My technical analysis isn't as good as it used to be. But basically, the weekly charts are all very weak. But the longer term charts, the monthlies, are like holding in. They're like, so part of us is like, all right, we got to be really careful here because this market in the shorter term, intermediate term, is quite weak. And it argues that we're in a bad month of the year for this to happen. Now, also going overseas, the DAX is weak. The CAC 40 keeps making lower lows. The emerging markets index is at support, but it can't seem to bounce, which is kind of curious. And then the whole thing with FTX. Now, FTX is a funny way of warning. They claim it's the world and it's the economy, but it's actually them. I only go back to the whole thing with Amazon a couple of years ago when Amazon took away their deliveries, and they blamed the world economy for it. So sometimes FTX isn't always there in terms of what they're really telling you, but it's still a warning, and they're still dramatic every time they do it. It's like once every couple of years they get all excited. Overall, sentiment's pretty poor, and that'd be a reason for sellers to really start selling the market lower. So we're looking for the S&P around 3,800, 11.6 on the NASDAQ. Below both, the fireworks really start lighting up. We saw a whole bunch of stuff this morning about 3,600 for market strategists. That sort of concerned us in terms of being bearish. Like every time these market strategists decide to get bearish, it's time to get bullish. So perhaps this morning is an option hangover and we go higher. But the weekly charts are very weak. And that chart on the S&P is ominous to us.
Okay, I think we have another chart there you wanted to send through and talk about as well, right?
Well, it's related to the next question, but
Okay.
It's essentially go ahead and I'll follow on it.
So Nvidia hosts an AI event with experts speaking about how AI and the evolution of the 3D internet are profoundly impacting industries and society as a whole. Obviously Nvidia will be there, but there's some big companies there: Amazon, Ericsson, Lowe's, Verizon, Johnson & Johnson, and Volvo are just some of the names that will be speaking at the 3-day event. Brendan, you and I have been lucky enough to come up through an era where we've seen technology come along so far in the last 30 years. But we've also seen when we're in a tightening environment, like we're starting to enter right now, the budgets can shrink. There will no doubt be some very interesting things coming out of this, but a corporate's more concerned about creating the next piece of virtual property or about battening down the hatches ahead of a potential recession.
So on that chart, you got me thinking on this one. So I was like, all right, does R&D get cut back? When do they cut back R&D? Well, a lot of these corporate managers don't start cutting back R&D until earnings is actually rolling over. And earnings is not rolling over yet. It's slowing, but it hasn't rolled over. It probably takes another quarter of downward earnings to get this R&D budgets cut, which still argues that they just keep pushing forward. Technology is what ultimately drives it. You sell your products ultimately drive your revenue. So in a way, you almost force the products out there to sell. So essentially, from an R&D standpoint, I don't believe you'll see R&D actually turn lower until earnings really start lower. And earnings remarkably are holding in. And for that, I guess you could say corporate managers are not going to batten down the hatches. They're sort of just going to ignore what's really going on in the markets. It also actually argues that these guys don't watch what's going on in the markets when they're doing their budgets. They look at their bottom lines. And I always had a thought before this was that they actually do react to the markets, but I don't think they actually do. And it was kind of fascinating to actually chart that. Anyway, forward earnings are not diving. That's the key level we're going to watch. They'll also lay off expensive employees first if they need to cut budgets. I think they're all excited. I think a lot of companies are more excited to do that than anything because these higher wages, especially for those at the top end, are getting paid more. And I know transferring of jobs is raising wages, but I still think if they lay off the more expensive one and hire the cheaper one, they save on the middle. So they can keep doing that for a little while, maintain their R&D, maintain their development of new tech, and that moves on. So this AI conference, it's funny because Nvidia is one of those companies that just starts reporting lower and lower earnings these days. But this conference, they'll probably have plenty of great stuff talking about it, and they won't talk about the markets too much.
Okay. Now, more on the technology side, the merge is behind us. Does this make Ethereum the ESG-friendly cryptocurrency? In an ESG environment, does this give it that extra edge? Investors didn't think so because Ethereum closed down 19% last week, and it's even weaker again over the weekend. Brendan, how does the chart look to you for Ethereum? And do you prefer Bitcoin or Ethereum?
So I did some thinking on this one. I try to think on every one of them, but this one really got me wondering because we don't trade Bitcoin nor Ethereum, economy, but we monitor it and we chart it, and we put those two charts in last night. And one thought that came to us about Bitcoin was it's stabilizing at a certain level, like a real currency for once. Ironically, we post that and all of a sudden it cascades last night, but whatever. Ethereum was very weak going into last night. It showed a breakdown on the chart and it looked like it was going down to 1100. Part of the interesting part of Ethereum is that I think it rallied because it was a short squeeze. I think people had to do the merge and they didn't know how their shorts would be transferred over in the merge. So they just covered them. Now they're reestablishing all the shorts. The ratio of Bitcoin to Ethereum is falling again. And that just argues that we're going back to where we were before the rally, before the merge. Now, I've had people tell me about ESG being a big deal, electricity usage being like 99% lower or some silly number. But I think this is ultimately about trading. And on Twitter this morning, I can't tell you how many people are panicking on Ethereum alone. I think a lot of people bet on this going higher based on the merge, but I think it was just a short squeeze. I think it was an old-fashioned short squeeze that pumped Ethereum higher. Bitcoin barely moved. Right? I mean, it's been between 18 and 22 for like a while now. It's like for a long time, almost 4 months. This one, that's Ethereum. Yeah. So I would just say that I don't prefer either one of them to answer your question. I'd rather right now the chart of Ethereum looks more definitely going down. If Bitcoin starts to break through 18.5, that changes the dynamics, and then you're looking at 10,000 there. So those are the big charts. But Bitcoin, every time it comes down here, it finds buyers, and it remains in this solid range of sorts. So I don't know. I don't know if I'm not smart enough to know which one is which. I'm not sure to own which one or which, but I can tell you Ethereum's falling more aggressively right now than Bitcoin.
Okay, well, it's interesting. I was talking offline to Maddie about this. Obviously, ESG is such a big part of a lot of investing right now, but I correlated it to SAP in Germany. when they moved towards the cloud. And there's a lot of negative people about that then, and the stock price held for the longest time or flooded around. And then all of a sudden they're like, oh, we're on the right track here of doing what we've done. Maybe that might be a comparison here for Ethereum.
It's well, or even Bitcoin. Like Ethereum is it's the technology and the backbone for like the whole NFT universe. You think, but the token itself is not the tech, and a lot of people make that mistake. You know, it's like, all right, the tech can be wonderful. The internet was a wonderful thing. Did Pets.com survive? Look at it that way. I mean, it's just like it's a wonder. The technology and the blockchain, I think, are definitely here to stay. I think they're going to flatten industries when they really take hold. Like lawyers are going to have a lot of trouble when all this stuff starts going out. If the blockchain makes contract law, like solidifies it, it's just I keep going back to the tokens are not the tech, and the chart is the chart, and people are trading this thing, and they're just shorting it right now. I mean, there's so many derivatives that do it these days. Bitcoin, on the other hand, maybe it's starting to become a currency. Maybe this is where it ultimately settles. I don't know. I mean, everybody wants Bitcoin to be a currency, even though it has no tech, and it trades on the Ethereum blockchain. So the whole thing's kind of confusing to me sometimes.
All right, so let's go back to like our original question we started the show off with. And I want to look at some zombie stocks. Some of you watching may be thinking, what is a zombie stock? Well, zombie stocks are companies that earn just enough money to continue operating and pay interest on their debt, but are unable to pay off their debt. New Construct's David Trainer recently had an interview with Brian Pellegrini on OETV discussing zombie stocks, and you should all check out that show because it really breaks it down very well. Brendan, let's take a look at 4 companies that fall under the definition of a zombie stock. Let's start with Carvana. They're a huge winner from COVID, but what a cool-off we've seen in this name. With a shrinking economy, can more bad news be around the corner for them?
So Carvana is interesting. I hadn't looked at the chart in a while, and I thought it was much lower than it currently is. So when I took a look at it, I was like, this is surprising. There have been numerous stories of them going out of business all year. Like once the Manheim Index rolled over, people like Carvana is dead. You know, they're gonna sink. But look at this in the chart; it has bounced. It's got some like 2 nice bounces off of July lows, which had us wondering, all right, what the heck is going on here? U.S. cars, like used car sales, I think the prices turned back up in May, but the amount did not. So you have one of those interesting developments where you're getting higher money for your sales, but you have lower sales. So Carvana is making higher margins, which higher margins ultimately lets you pay your debt. Ultimately, again, if you don't have enough revenue, you can't pay that debt because you don't have enough to raise for it. The climb off the lows, though, I think was probably a short squeeze. I think they have a short interest of about 27%.
Yeah, yeah,
very high. And if you notice, it's not on this chart, but weekly volumes have abated. Like the bounce went up and then the volume started to tail off. That tells you that the shorts kind of, all right, they're convicted that they believe this company's going down. I can't tell you one way or the other. I still believe the used cars market is some sort of bubble of some sort. I go back to the example where I had one car that I paid X for. 3 years later, the lease is up and the car is still worth X. I literally drove it for 50,000 miles and yet they still think it's worth X. That's a bubble. I know inflation is around. So Carvana benefited from the bubble. If the bubble were happen to burst, they're in trouble. But right now, the chart argues may not be yet. The stock overall is very much a mixed bag. The economy could say things are terrible. Well, they could say things are terrible with the economy. They could tout cost savings. That's one of I think Bloomberg said one of the things that Carvana is doing is cutting costs. They can do it. They don't have the flexibility to jump between used and new to sell cars, but they can contain costs pretty well. So that can help them a little bit. Stock's been holding the 20-week for a while on the way down. So the shorts aren't as convinced that they should hammer the stock yet, but there's nobody really buying it either. So I don't like the story overall. If you still believe used cars are a bubble, Carvana is going to adversely suffer from such. I don't know. And they have a station in Danvers, which looks like hell. I mean, it looks like they haven't updated it in 2 years. That tells you that the costs are really hurting them because they had a nice, crispy, clean station. That's part of your marketing effort, right? And
Yeah.
if you make it look like crap compared to the Porsche dealership across the way, you're not really helping your case. So I think they're not in great shape, but the shorts, like 27% interest is really high. I mean, your best shorts are not 27%; they're from 3%. So I don't know what's good. This stock could ride even higher based on that amount of interest. It's just one of those weird things.
Yeah. Well, Freshpet's not the next one to look at, and decent amount of short interest in this one as well, like 12.5%. They missed consensus estimates when their earnings back on August 8th. We've talked about the explosion of pets during COVID, but we've also talked about the concerns for that growth in the event of a slowdown in the economy. They've announced some leadership changes, which is trying to address the continuing losses for the company. Brendan, even as I look more into this, I have more concerns for this share price. How are you thinking for Freshpet?
It's an interesting story. So we talked about Chewy a few weeks ago, if I'm not mistaken. These guys are building warehouses to take advantage of rising prices. Now, I don't know where they were 2 years ago when prices started to rise, but that's neither here nor there. But if you believe inflation is going to be an issue going forward, and you sell pet food, and you want to get ahead of the price curve, well, you'll start building it. You'll start building up your inventory of offerings to sell, and that's where these warehouses come in. They get some fancy technology to go with them as well, according to Bloomberg or some other analyst report. There's also a feeling that the forward expectations are too conservative based on these warehouses and what they'll provide. I don't know if Chewy's report wasn't the best, so that, I mean, they said customer growth was slowing. That goes to the whole, we can't afford our pets because inflation's hammering away. So Freshpet has to have the same problem. I mean, if they don't, I'd be surprised. And they also have a higher level of food, like they're at a higher price level, if I'm not mistaken. I wouldn't. If people are trading down, that's got to hurt them to some extent. Dog food's up 20% from a year ago, easily. But at the same time, the stock price actually put in a reversal, and off of 38 and bounced back. Another stock that's kind of surprising that it bounced. So I think this comes down to bargain hunting. And if these guys are actually building warehouses to take advantage of prices, that's a benefit to their margins going forward that's not being priced into the stock. I'm not saying buy it, but the stock did put in a reversal, not a great reversal last week, but a decent one. If the news isn't terrible, like the market's pricing in, I could see a little short squeeze coming out of this, because they're saying, all right, we're going to do better. They have two different trends working against them. So it's a tough stock to own, but they're showing some life, if you will. Okay.
Well, the next one is Beyond Meat. And remember when everyone was shouting how good Beyond Meat is? I was not one of them.
Yeah.
People were paying more for their product than they were for actual meat. The press couldn't get enough of them. They were praising them nonstop. Well, the tide has turned. The Wall Street Journal yesterday writing that Beyond Meat is beyond hope. In that article, they point out on a Gallup poll that estimates that 5% of Americans consider themselves vegetarians. Brennan, is this one really beyond hope?
That's too convincing. Anybody has that much conviction for anything that's just sensationalism. But the chart is pretty ugly. I remember talking to somebody off the ledge and buying the stock when it was 160. I said, "This is a fad." I was speaking my own book because I'm not a vegetarian, and I'm going to buy a burger. I'm not buying a fake one. It took them a long time to get ground after that. I think it went up to it's on that chart, 180, and it's just been falling ever since because the fad wore off. The pandemic didn't help. Sorry, got sidetracked there. I wouldn't say it's beyond hope, because there is a brand there. They have brand leadership in certain areas. They're tied into certain grocery stores. I read an interesting thing that Wendy's, I think, sells, or KFC sells, chicken nuggets made of this stuff.
Yeah. And
they need more than a nugget of KFC to survive. I thought that was a fancy little headline. But inflation pressures are killing them. I mean, their costs are going up. 5%. Let's just look at it this way: if only 5% of America is a vegetarian, and there is a lot of competition for vegetarians out there. If it's only 5% and that market is not growing like they all told us it was 3 years ago, 3 years ago, the stock's in real trouble. It broke through lows in a pretty heavy way. I think some could say that was a capitulation of sorts. The Wall Street Journal probably just jumped all over that and said, hey, let's jump on this one. The story's not great. I still don't like Beyond Meat, even at this price. They're still expensive on the shelves. Even with inflation, they're still expensive. And they haven't really raised their prices when they should be raising prices. It's just not something I would own. I think they are. I hate to say I agree with the Wall Street Journal here, but I don't know if Beyond Hope is that. I mean, they're a brand, so somebody will probably take them out at some point. I mean, it's a brand, you know. Those get there. Was it? What's the other one? Impossible. The
Impossible, yeah.
I don't know. I haven't seen Impossible Burger in a while, unless they're still making Whoppers. But Beyond Meat, they're not Beyond Hope, but they're probably going. They're definitely going lower. It looks like, and they'll probably be a takeout candidate in the tens.
Yeah. Well, it's actually, I just brought up the chart of Peloton on the side. It's a very similar chart to Peloton, which is another zombie stock. So let's move on to the last one we're looking at, Shake Shack. Now, I love a good Shake Shack. It's a very good comparison, Beyond Meat, Shake Shack. They're in a very highly competitive space. Great product, but they have cash flow problems. I want this company to be really successful, Brendan, but are there too many headwinds ahead for them?
They made a mistake by focusing too much on the cities, and they didn't make that. So there's competitors out there to them. I mean, everybody's got a shake and a burger these days, but and they're all over New York. Like my daughter, we went to New York, I don't know, a year or two ago, and she wanted to go to a Shake Shack. That was it. She wanted to go there. We went in there, and I just wasn't really blown away by it, but whatever. 12-year-old girl wants to get Shake Shack, all the power to her. A 13-year-old girl. But I would just say that their mistake was staying only in the urban areas. They should have followed the money. The remote world has sent everybody home. They should have, like in my area, Wahlburgers is the same sort of company. It's Mark Wahlberg's thing, and he's got a bunch of them. He's in the suburbs, so it's like he's benefiting from that. Shake Shack would have as well, but they didn't make that move, and they bet on the cities. The cities are coming back slowly, but if like New York is more exciting these days, Boston's woken up a little bit. San Francisco apparently still 30% less than a year last time. So I don't know if Shake Shack's even out there, but you know, you get my point. These cities are just not coming back quickly enough for them. Costs remain a problem, wages, and they're having supply concerns getting the food. Wages are killing restaurants everywhere. So if you're on the border, like we had a burger chain in Merrimack, open for years, a place called Skips. Been open for 70 years, and they sold shakes and burgers, and well before Shake Shack existed. They just closed down, and they closed down because costs are getting too high on the wage side. It's a family-owned business, so it makes you wonder: is Shake Shack ultimately going to run into the same problem where costs overwhelm them? I think they're a viable company. They just got to transition out of if they can make the move to the suburbs and get near the remote workers, I think they'd do better. But they're not quite there yet. So it's a work in progress.
Okay. And once again, that's another one with decent short interest in it as well, like 9.2% of the company, but nowhere near as bad as Beyond, who we bought up just before, and that's over 33%.
Yeah, I will say Shake Shack actually has the same chart as Carvana in a way, which means the shorts were on this and covered. Maybe this is a trend. Maybe Carvana and Shake or Shack or how you want to call them. Maybe there's something developing there for the long term. I don't really know. Maybe it's an inflation story, but they work on opposite ends. It's interesting that you're seeing it in the charts. Usually the charts tell us well ahead something is developing. Shake Shack is held to June lows. Carvana is held to June lows. I don't know what's coming next.
Okay. Well, let's move to like it, love it, leave it. Now, usually we do earnings previews, but this week we're going to pick on some companies got earnings this week. So let's get into it. Let's start with Costco, and they report on Thursday.
So I like it. I hit the 20-week last week and bounced back above it. Rising breath and momentum still in place. Markets are weak this morning. I haven't seen where it's trading, but I'd say it holds it and goes up. It breaks to 480. Last time it broke, it got really hefty. You could see back in May where the longs all bailed at the same time. They may not do the same thing yet, but I like it.
General Mills on Wednesday.
I would leave it. There was a breakout projection around 76. I think we covered it in earnings, if I'm not mistaken. It went above it and then below it, so I would leave it.
Okay. FedEx aren't reporting this week, but obviously I just want to put that up in the chart.
I'm going to say like it. The thing has fallen like a stone, and it landed right on one of our supports, range supports. This is the ultimate in buying a falling knife. So wear thick gloves. It hit big support at 155 and turned. It was up this morning in the pre-market with the futures down. So the only fear is I trades like an Nvidia and just keeps falling, but I like it.
AutoZone reporting this afternoon.
As a side note, I can't believe this stock is at $2,300. I haven't paid attention to AutoZone in ages. I like it. Hit 2,300, pivoted lower, then hit the 2,100 level, which is the bottom of the range. Bounced higher last week. It's another chart with the same candle as Carvana and Shake. Strangely enough, I don't know what the relationship is here. It's all consumer though.
Okay, and then Lennar, they report on Wednesday after the close.
I'm going to go against the tide of the market in general and leave it. It broke through support 78. Looks like it's going to sub 70. Home builders have it really rough right now. I think it's only the beginning for that. It's a very tough business to be in.
And the last one to look at is Darden Restaurants on Thursday.
I like it. I think the major chains are, if you're going to buy restaurants, you want to be in the major chains because they can spread out their costs. So I like it. It's holding above support at 128. Breadth is a mixed picture, which doesn't make it a rocket ship of sorts, but I like it.
All right, Brendan, listen, thank you so much for your show. A lot for the show today. So much to take in. It's going to be a very interesting week for markets. So good luck out there, Brendan.
Have a good week.
And for everyone else out there, good luck investing.